Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in this video I'm going to share with you guys 5 top blue chip companies that have been around for a very long time. They are fairly valued right now, which means they are trading around their intrinsic values. These are genuinely top companies. They have a wide moat. They are fairly valued right now. Potentially one of those companies that you buy and hold for a very long time and just leave them alone. So I'm going to give you all the information that you need about each one of the companies. But before we get to that, just press that like button because it genuinely helps the channel. That's the only thing you could do. If you can join us in the Patreon account, that's even better. If you can, you will have access to the family portfolio, the Discord, and loads of other things, including undervalued stocks. You get access to the Sharia compliant investing ebooks and then dividend trackers that I've created for the UK and US based community members. So let's now get to the 5 companies that we came here for, and as usual we're looking for the same more or less information that we always look for. We're looking for if the company has a moat. So every single one of these companies has a moat, which means they are basically protected against their customers. Basically their products are basically standout products, so they have a slight protection against their customers and their competitors. We will need to see the market cap, how big the companies are. If they pay any dividends, we want to see if that dividend is safe and so on. We want to see if the company is profitable, so how much of the revenue basically goes into becoming gross profits and so on. We want to see the return on equity, return on invested capital. So how much money, basically how much they generate. So the company gets, of course, money from us and from the sales and so on, and they reinvest in that. So how much basically in terms of profits, in terms of more profits, basically how much are they generating and so on. Then free cash flow, and then we want to see the total return the last 10 years. We want to see EPS growth for the next year and revenue growth. So we're only focusing on just next year, because we want, sometimes analysts predict 2, 3, 4 years from now on, and that's quite difficult to tell. 1 year is easier because the company will actually tell you what they will expect by the end of that year. More or less basically hit those targets. If they don't hit the targets, of course, the stock tanks and all those sort of things happen. And then we want to see Morningstar valuation. So let's have a look at the first company, and that is Intuit. Intuit is one of the companies I do own in my portfolio. They work with basically a lot of small businesses. So they have a lot of small business solutions, including QuickBooks. They also have some tax preparations for basically software called TurboTax, which helps the small businesses and so on. They've got personal finance management, basically systems that helps a lot of customers. They've got financial ecosystem. They've got AI and data driven basically solutions and so on. So they are in the right industry, if you like. 169 billion market cap, wide moat. Current price is about $600 per share. They do pay dividends, and that is actually slightly lower than we normally want, but however the growth is what's important. All of these companies, the ones that pay dividends, are slightly paying lower yield right now, but the growth of it is actually absolutely amazing. So the payout is only 22%. That's 22% of their net income. Latest increase was 16%. The 5-year growth rate of 14%, and dividend streak of 12 years. Annually, they will give you $4.16. Safety 98%. The highest any company gets is 99%. Then we've got 17, almost 18% profit margin. We've got return on equity, that's about 16-17%. Return on invested capital about 15%. So absolutely amazing. $5 billion of free cash flow, 22% total return the last 10 years. EPS growth expected to be about 14%. Revenue growth to be about 12%. Fairly value right now, $640 per share is where they think the price should be. Now, for the 1 year, you can see the company is down about 6%. So last year, the company has not actually participated in the wider market and how AI and everything else went to the moon. So we will see what happens with this year. But as you can see, the growth is there, double digits every single year, with revenue year-over-year growth in terms of EPS is almost exactly the same. And if we look at what the ratings is showing in terms of Wall Street, as you can see, we've got strong 16 strong buys, 7 buys, 8 holds, 1 sell. And that is about $725 per share. That's about 21% upside from where we are right now. The next company we're looking at today is S&P Global. This company is a leading provider of financial information, analytics, and ratings. It plays a crucial role in the global financial markets by offering insights, benchmarks, and tools that help individuals, businesses, and government to make decisions. So it is probably one of the best companies out there in terms of basically monopolizing that market. There are not that many companies that do exactly what this company does. It has a market cap of $156 billion. It has a wide moat, $513 per share right now. Again, another very small dividend yield, but again, look at the payout ratio, it's only 24%. The latest increase was only 1%, but the 5-year growth rate is 12%. Now that means because they have increased this dividend for 50 years, this is a dividend king. Annually, you'll get $3.64. Dividend safety 99%. Like I said earlier, that's the highest any company can get. And the profit margin is 25%, return on equity 10%, and return on invested capital 10%. $5 billion of free cash flow right now. That's a bit weird. They're very similar. Let me double check that. It is actually true according to the website that I got the information from. Wow, that's interesting. Both of them have a very similar free cash flow. Just total return in the last 10 years for S&P Global is 19%, and it's expected to grow earnings about 10% and revenue about 6%, which is really good. Fairly value right now, $480 per share is where they think the price should be. By the way, if you haven't liked the video already, please do so. It really helps the channel. Now, looking at moving forward for the 1 year, as you can see, it's been up about 15% for the 1 year. So from this time last year up until now, it's up about 15%, which is decent. And when we look at the earnings expectations moving forward for this company, you can see based in 2024, they've got one more quarter to report, and then after that, basically you can expect double digits in terms of revenue growth year over year. And then when it comes to when it comes to EPS, when it comes to revenue, it's about 6-7%, which is absolutely decent. And now if we look at the ratings for this company, we've got a strong buy here. We've got 14 strong buys, 6 buys, and 2 holds. So great to see that. So it's $580 per share, 13% upside from where we are right now. The next company we're looking at today is Salesforce. This is one of the leading cloud-based software companies specializing in customer relationship management solutions. It provides, or what we call CRM solutions. It provides tools and platforms that help businesses manage customer interactions, streamline sales processes, and deliver personalized marketing and customer service. This is probably one of I've always said this company will become the Microsoft of the future, and it is definitely heading that direction. They have so many moving parts when it comes to their business side of things. Currently, it has a market cap of $311 billion, white moat, $334 per share. Again, and they've started paying dividends very recent, so that's 0.5, which is fine. The payout ratio is only 12%, and of course, they haven't increased in that, so they only started it last year. And as you can see here, you get $1.60, which is decent. 80% safety, profit margin about 16%, return on equity about 10%, and return on invested capital of 10%. Free cash flow, we're looking at about almost $12 billion. Total return in the last 10 years, we're looking at about 19%. EPS growth for next year, we're expecting about 12%. Revenue growth of 9%. Fairly valued, $315 per share is where they think the price should be. The next company we're looking at today is Texas Instruments. It has a market cap of $176 billion. This company is a global semiconductor company that designs, manufactures, and sells electronic components used in a wide variety of devices, especially known for expertise in analog chips and embedded processors. Company has wide moat right now, over $200 per share right now, 2.7% in terms of dividend yield, the highest we've got in this group of companies that we're looking at today. And as you can see, the payout ratio is ridiculously high. So I'm assuming in the next couple of years, this will be, because right now what we're saying here is 98% of their net income is paid out as a dividend. That cannot be a good thing because the company needs some money to reinvest in the business and so on, especially very innovative company like this one here. So latest increase was 4.6 and then 5-year growth rate 14%. Now dividend yield basically a streak of 20 years. Annually you get $5.44. Dividend safety of 80%. Profit margin 31%. Return on equity of 29%. Return on invested capital of 17%. $1.4 billion of free cash flow right now. Total return in the last 10 years, we're looking at about 16%. EPS growth expected to be about 17% next year, which is absolutely huge. Revenue growth expected to be about 10%. So this was basically down basically over the last whatever years. Now it looks like it's bouncing, but the company will be bouncing back from this. Fairly value right now $175 per share is where they think the price should be. And if we look at this in the Seek and Alpha, we can see, let's go to earnings first. Okay, as you can see here, we've got 27% basically expected to grow about 27%. Are we looking at the year? Wow. Okay. So it looks like this has been updated. So as you can see here, we've got for 2025, which is basically the year they've already started, we're expecting about 12%, then 27%, 22%, and then here you can see 10%, 14%, and so on. So overall, it looks like it's growing really fast. It will be interesting to see what analysts are saying right now. As you can see, it's a hold across the board. So 10 strong buys, 2 buys, and then 20 holds, 3 sells, 3 strong basically sales, and then basically 1 strong sell. Now $207 per share, about 3% upside from where we are, so nothing huge to worry about or anything like that with this company. And the final one is Fortinet. This is one of the companies that does not pay any dividends. This is a cybersecurity company. The company is a leading cybersecurity company that provides a wide range of solutions to security networks, data, users, and applications from cyber threats. The company specializes in next-generation firewalls, network security, and threat management, and it caters for all types of businesses, including to businesses and governments and service providers, and also to companies basically. And as you can see, it has a wide moat, $97 per share right now, no dividends right now. Profit margin, return on equity, return on invested capital, probably one of the best out there, if not the best within this set of companies that we are talking about here today. Free cash flow of $1.6 billion, total return the last 10 years, 31%. EPS is expected to grow about 8%, revenue is expected to be about 13%, fairly value right now, $88 per share is where they think the price should be. And as you can see, this stock has done really well over the last year, so 51% up since from this time last year. If we look at the earnings expectations moving forward, I've shared some of it with you guys, but you can see 37% for 2024, 2025 about 8%, 2026 about 14%, and so on. So almost a double-digit growth expected almost every year for EPS. Revenue side of it also exactly the same, basically double digits. So it looks really good overall. Let's now look at the Wall Street expectations. So we've got 9 strong buys, 7 buys, 25 holds, and 1 strong sell. They expect the price to be $98 per share, and that's about 1% or 1.5% upside from where we are right now. So that's the 5 companies I wanted to share with you guys today. These are type of businesses that you want to own in your portfolio, and instead of running after the next shining thing, whatever, these are well established companies. They have a growing revenue, as you can see. They have excellent free cash flows. They've basically very profitable businesses. The fact that some of them have been paying dividends over 50 years or so, that's a credit to the management and the company and so on. So this is the type of businesses you should own and hold in your portfolio and leave them alone for a very, very long time. Because in the end of the day, is trading in and out of stocks is really not a good idea, especially if you own some of these companies and you're up. It's very tempting to sometimes sell and take profit off tables and so on. But yeah, so overall, really great companies, and here are the Sharia compliance side of things. You can have a look at them, pause the video. But I'm going to tell you very quickly, I do own 4 of these companies apart from Texas Instrument. I did own this for a while ago in the family portfolio, made a little bit of profit, sold it, haven't owned it since. It looks like it's coming back. My concern is the fact that this company pays the dividends, but the dividend is basically payout ratio is very high. The rest of them, I really like them. This one hasn't done anything as we've seen at the beginning, so I'm giving it a bit more time to actually bounce it back, because right now I do own it in the family portfolio and in this portfolio as well. Just to be honest and transparent with you guys, I'm just going to very quickly show you basically these companies that we talked about. S&P Global, you can see it's there. The next one that we've looked at today is Salesforce. They're another one that I'm up about 46%. Intuit about 10%, which is basically not bad. And the fourth one is actually, like I said, it's in the family portfolio, this one here, and I've owned it for a while now, I think for maybe about a year, if not less than a year. Anyway, that's the 5 companies I wanted to share with you guys. These are 5 high top, basically blue chip companies that you could potentially do a bit more research on. Please don't take my advice as a financial advice or anything like that. Do your own research, inshallah. Have a wonderful day. Assalamu Alaikum.